Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer, and today we are going to be looking at a REIT, Alexandria Real Estate Equities, ticker ARE. This one came in by request down in the comments section of one of my other videos. If you have a stock you would like me to take a look at and analyze on the channel, just put it down in the comments, and I'll get it on my list, and I will eventually make a video. If it's a stock that's in the S&P 500, which Alexandria is, I'll make a free YouTube video. And if it's not, I post the other videos over on Patreon, which is only $5 a month. And then if you join there, you get a big discount if you decide to join my full Cyclical Investors Club service over on Seeking Alpha. Those links will be down in the description. So I've had a couple requests for Alexandria Real Estate Equities Inc., AER. I have owned this stock in the past, and REITs in general are a little tricky for me. I had to think about this for a little while because I have a REIT strategy that it's exclusive to the full Cyclical Investors Club service. I don't write about REITs at all, basically, publicly. Part of the reason for that is over on Seeking Alpha, there are a lot of REIT specialists. And so I just kind of let them do their thing there, and I kind of have my own little REIT strategy. The other reason is my REIT strategy is very unique. I created it myself, and it's also pretty simple, but not entirely intuitive. So I just kind of keep it to the members and keep it to myself. And what I do is, and I'm not going to explain the entire strategy, but I'm going to give potential REIT investors some tips. So I'm going to try to kind of walk a line here where hopefully I can help people out that are thinking about investing in REITs without just kind of giving away my entire strategy for free to the internet. So it'll be a little tricky here, but I think I can get the main points across that I think people should know. Let's see. So first of all, I always review any previous coverage I've had of a stock. I haven't ever written or made a video or anything on any REITs for a long. I think when I first started writing, I maybe did one or two, but basically for the last 8 years, I haven't written or made a video about a REIT. So I haven't done that, but I have actually owned this one. And so I want to just give so it is going to be kind of a good example because I owned it from December of 2020 to September of 2022. So 21 months, almost 2 years. And when I sold it, I was down a total return of almost 15%. S&P 500 was about flat. So this was a loser as part of the strategy. But what I wanted to point out here on this fast graph is this is about the time I sold it, and this is where the stock is now. So since I've sold it, the total return over the past year or so has been down more than 20%. So it looks like it was a reasonably good decision to sell, even though I lost money when I did. So that's my history with this stock. And now I'm going to kind of give my thoughts on REITs in general. I would say if you want to, probably the best book to read is, well, I'll give you two of them. One of them has kind of a brief thing about REITs, but it has a bigger kind of section on the concept of reflexivity, which is a George Soros concept. And I think, you know what, I have both of these books here. Let me grab them real quick and I'll show you what they are. I'm not well prepared, but I have most things within arm's reach sometimes. So the first book would be The Alchemy of Finance by Soros. Just forget about his political stuff. This is a very interesting book, and the key thing that you should pay attention to is he made a lot of money, I think, on REITs in the 1960s, and even if he didn't make a lot of money, he understood the concept of what was happening back then which is a long time now that I think about it. That's like, over 60 years ago. But that's when this first concept regarding real estate and REITs and reflexivity, where I first learned about it. But the book that I recommend more than that one, if once you understand that basic concept, is a newer book by Howard Marks called Mastering the Market Cycle. Okay, and he actually has, unlike his first book, he actually has a section on real estate in here where he basically explains everything. So I'm not going to get into like the details of real estate cycles, but what I will say is, I view real estate, like if you talk to a normal REIT analyst, commentator, investor, they'll get into something like, they won't use earnings, but they'll use like free cash flow, like FFO or something. And so they'll look at this, maybe they'll look at, that's probably the metric that they would use. And they'll try to use some kind of fundamental analysis to explain the stock price movement. But to me, the real thing that explains stock price movement in REITs is basically their ability to borrow money or raise money, buy real estate, have that real estate appreciate in value, and then buy more real estate, and then have that cycle basically compound over time. So, and it sort of feeds on itself, which is kind of where the reflexivity comes in. So you get these big cycles usually, and you can see we had one. We'll just look at this particular REIT in general. We had one that started after the real estate collapse in 2008, and then you just have this kind of steady up until, when was it? Just 2 years. It was the market peak like 2 years ago, basically when the Fed started raising interest rates. And now you have this down cycle that we're in right now. So that's like the basic cycle. But what happens is the asset values come down, and therefore and so you can't like borrow as much money against it, right? Like that whole credit cycle works itself out. I really view real estate investing as just a credit thing mostly, if you're doing it well. So the fundamental thing that I would tell everybody to look at, and that I look at when I look at a REIT, is actually, I want a long history. I would say minimum 5 years, but really it's much better if you get that before 2008, so you can see how they did and whether they like survived. Because some of these businesses are just like total junk. They're just designed to like take investors' money. So I like to first check and make sure they have a history of success. So that would mean they're a good REIT investor, the management or whatever their structure and plan is. And so when you look at Alexandria's history, even with this giant decline we just had, they're still like outperforming the S&P 500 by a double since the mid-90s. So they have a history of success. So that's good. That's the number one thing. If there's no history there, I don't even consider buying it, because nothing gets exposed that's bad. And it's just so easy to cover bad stuff up until kind of the shit hits the fan. And then all of a sudden you're toast, right? And there are a number of ways that can do that. Sometimes it's just a bad business, and I don't have time to dig through trying to investigate every single nook and cranny of these businesses. And most of the people that do don't can't figure out anything anyway until it's too late. So I just look for the history of success. That box is checked with these guys. The next thing is, because these are like these big cycles, what you really want to do is avoid the big downturn. That's the number one thing. Once you have a good REIT. So once you think, and you kind of have to learn about cycles. Actually, you'll learn about that in Marx's book. That's a great book to read because you learn about everything about cycles. So you learn about that, and then you have to make a determination at some point. Is this a down cycle? Like, is this a credit down cycle? Is it a real estate down cycle? This is economic down cycle. And when you decide that's coming and you see the stock price start to do this, that's generally a good time to sell. I have other specific metrics that I look at. They're just that I key in on. But generally speaking, this is what you want to. It sounds obvious. This is what you want to avoid. But if I told people, let's go back to the fast graph real quick. If I told people this stock could fall 75% in 2007, I mean, nobody would have believed you. And so the same thing kind of happens here. I don't know how much it's fallen off the top. 50%. So is it cheap? Well, it's not as cheap as it was in 2008. Now, I don't know if things are going to get as bad as they did then. But all the people that have been buying all the way down, right, probably expected, hey, the bottom's soon. Maybe, look, you can almost see a double bottom there, right? And they were wrong because they didn't really understand what the downside can really look like. So the main thing is you want to avoid these really sharp downturns after you get a quality REIT. The next thing is, well, where should you buy it? And honestly, the technicals are the best. I'm not a market technician, but if you just, and I have my own metrics that I specifically use for REITs, but if you just take a 200-day simple moving average, I would say the rule of thumb is you want 2 months above that, at least 2 or 3. That's probably a good sign. This is after it's had a decline, obviously. Well, it wouldn't be below the moving average if that hadn't happened. But this is 2008 here. If you would have bought around November of 2009, which is like right in here, you would have been good to go for the entire full cycle. So if we go to November, I think usually I did a bunch of research on this. I think it was November of 2009 is when most REITs became buys. Let's say you held that until COVID. You could have got a 13% CAGR. So over a long period of time, more than 10 years. Pretty easy money if you buy at the bottom and you just kind of hang on until you get to the next big down cycle. I went 2020 because you might have sold here given all the COVID stuff. Obviously, you would have done better if you even held up to this peak and sold kind of when I did. So zooming in a little bit, I mean, we can kind of see, when did I buy? That's 2021. So when I bought, we'll just look and see here. I bought right around here. And we can see the trend was still pretty good. At one point, I would have been up 30% in a year, which was good. That uptrend was still intact. But once that fell apart, and by about here is about when I sold, you could see, and then knowing all the kind of other things that are going on in the economy at the time, with the Fed raising rates, with student loans starting, with all the stuff happening. A lot of it has to do with rates, but the risk was high that this was going to be one of those sharp down cycles, right? So rather than holding on, you get out because you want to avoid those downturns. That's the main thing. Once you select a good REIT. Other than that, I mean, I don't have any great advice. But if you're asking whether I would be buying now, the answer is not yet. Here's the latest kind of look. So we want to be a little bit careful on these little bumps like this that you don't kind of get sucked in. That's why I say wait 2 or 3 months, or you can use a longer time frame than the 200-day, but everybody has access to a 200-day moving average, so it's a good proxy here. Now in 2008, you didn't even have any of these bumps because it just fell straight down, but you're having more of a gradual downturn, and it's not turned above that yet, so I wouldn't be buying here. Now, is this the bottom? Maybe, but I would not be buying. I have had 2 REITs that I did buy this year, and I track probably or check in on 300 or something a year. I'll check in and then I actively track some subset of that. So there are a couple that have individual patterns, but that got above it. I don't think I'm up on any of them. I think I'm maybe flat on one, probably close to flat on the other one too. But so there could be a bottom kind of forming here. It's not in with this stock yet. Now, my extra double, triple word of caution this time around is this could actually be a little bit different. Going back to Marx, not Carl, Howard, if this is like a sea change, he wrote an essay about the interest rate situation potentially being a sea change. We've had generally falling interest rates since about 1980 or the early 1980s, 40 years or so, and now that might be over. So a trend of lower interest rates will raise real estate prices, and we have this giant cycle. So I talked about these smaller cycles. When you have these gigantic cycles of like 40 years, and then when that shifts, I don't know what's going to happen, but there's a good possibility that REITs and real estate in general will not recover the same way that they did from this downturn up to here, this long recovery. That might not happen again. I don't know what's going to happen. So I would just keep that in mind. It probably would add an extra layer of caution in terms of weightings. I weight my positions 1%, portfolio weightings, and I limit REITs to 10 positions. So right now I think I have, at the end of 2022 or the beginning of 2022, I had reduced down to maybe like 3 or 4 REITs, and now I have like 6 out of 10. So I could still add 4 more. The ones that I haven't sold yet, I kind of committed to just holding through whatever kind of downturn this ends up being, even if it takes like a worse turn for the worst. And then hopefully those last 4 I'll be able to add somewhere coming out of wherever the bottom is, and then just kind of hold those through the next cycle. But I don't know. I mean, I wouldn't be rushing into REITs generally. I'm pretty bearish on them still. I don't think the recovery is gonna be super fast, unless interest rates come down and the economy stays fine. A lot of things have to happen right to have a really fast recovery. So, I mean, my base case is probably these keep going down more, and then you have like a slow recovery. Just for REITs in general, you definitely want to only have the ones that have a good track record. Avoid everything else. And I think that's about all I can say. You kind of have to decide for yourself, but I would ignore the dividend, even though that's usually a big component of REITs. The ones with the best returns usually don't have the super high dividends. So yeah, it's hard for me to completely talk about it. One, because my views are totally different than almost every single other person you're probably going to encounter when it comes to REITs. And I don't want to tell everybody exactly my strategy, because it's pretty easy for somebody to just copy it. I don't think too many people would, but it's possible. And then, people pay me to create these strategies and run them. So I don't think it's fair for me to give the whole thing away for free. But that's my basic kind of REIT lecture, I guess, and just my views. And maybe you can kind of read that Howard Marks book, think about it a little bit, think about what makes sense, look at what's happened you can put in just about any popular REIT here and look at what's happened. Really, since 2016, these REITs have returned almost nothing, most of them. And I see articles every day, popular articles that people love, on horrible REITs. Some of them are just mediocre. Because they're like chasing dividend yield, and it sounds good, but just be careful out there. Learn the cycles. Learn that they exist. Learn that these metrics that most people are looking at, I don't think matter very much when it comes to like publicly traded REITs. And then join the Cyclical Investors Club, and then I'll give you my full theory and everything. All right, thanks for watching. If you found this useful, hit the subscribe button, and I'll see everybody in the next video.